Hey everyone, welcome back to the channel, your number one source for income-oriented investing. And I think Christmas has come early this year, and it's funny because I actually said this in my last Horizons ETF launch video 3 months ago, but now they've launched another 9 ETFs. That's right, Horizons ETFs has recently launched 9 brand new ETFs, and 7 of the 9 are income oriented or designed for income oriented investors like us. So it's very, very exciting. There's a lot of great ETFs here to get to. Very innovative, very competitive. So let's check them out together. I will separate the video in really 3 different sections because there's, in my opinion, there's 3 categories of ETFs, including at the end, the 3rd section is they completely revamped their asset allocation ETFs, and there's a couple of really cool, innovative options for us income investors. So we got a lot of ETFs to cover in this video. Let's get to it right away. All right, everyone. So to keep things simple, we will separate it in 3 categories. We have a lot of ETFs to go through. So let's start with the first 2 brand new ones, which are 2 brand new enhanced covered call ETFs to the lineup. The first one is QQCL, the Horizons Enhanced NASDAQ 100 covered call ETF. As you could see, with a really, really nice high yield of over 15%. Keep in mind that yield could fluctuate, and this is really based as of November 1st. Based on November 1st, by the time this video comes out, the yield could be different, right? So QQCL, very simple, everyone. If you look at the holdings, it's basically 125% exposure, right? Because they're using approximately 25% leverage of their existing QQCC ETF, which is basically the NASDAQ 100 covered call ETF, right? So you could see that with that 25% leverage, obviously you're going to get a little bit more yield, quite a bit more yield than the QQCC one. And the NASDAQ 100, as we know, if you look at the holdings, it's a very popular index that covers the US market, very technology focused, as you could see. So this is basically the first new ETF. It's just an enhanced version, like the name says, of QQCC. So if you don't mind a little bit more volatility and you're interested in getting a little bit more yield and growth potential, QQCL could be a good option for you. The next one is ENCL, the Horizons Enhanced Canadian Oil and Gas Equity Covered Call ETF. So just like QQCL, it's 125% exposure to an existing covered call ETF, ENCC. Right, so if you look at ENCL, you look at the holdings, you'll see approximately 125% exposure. That's because of the 25% leverage of ENCC. So what is ENCC, everyone? Well, ENCC is basically an ETF that holds 10 of the biggest and high quality oil and gas companies, just like the name says, in Canada. So if you look at the holdings, you'll see the 10 companies here, right? You got the 4 big pipelines: Enbridge, Keyera, TC Energy, Pembina, and then the 6 big oil and gas producers like Suncor, Canadian Natural, Tourmaline, Imperial, etc., etc. So really, really high quality stocks in ENCC. And this is a covered call ETF, which has a really nice high yield north of 14% as of November 1st. So ENCL is going to have more yield because it uses 25% leverage. So just like QQCL, if you don't mind a little bit more volatility and you want enhanced yield and potentially more growth over time, ENCL could be a great choice for you. And by the way, both ENCL and QQCL have 85% a management fee, 0.85%. The MER, of course, is not out yet because the ETFs are brand new and we need to wait a year for them to come out. So in short, if you like QQCC, if you own it, or ENCC and don't mind, you want a little bit more yield, a little bit more growth potential, and don't mind a little bit more volatility, because leverage does add volatility, you can now consider the leveraged versions, right? ENCL for the oil and gas one, and QQCL for the NASDAQ 100. So that covers it for the first 2. Let's check out their 3 brand new ETFs now, which actually does option strategies on US Treasury bonds. Very interesting. All right, everyone. Next, we'll focus on 3 brand new ETFs, income-oriented, that focus on U.S. Treasuries. So you have LPAY, which is the long-term U.S. Treasury premium yield ETF. You have MPAY, the mid-term U.S. Treasury premium yield ETF. And like you probably already guessed, SPAY, the short-term U.S. Treasury premium yield ETF. So there is a lot of similar ETFs that have come out from competitors like H-Bond from Hamilton or HPYT from Harvest. But I really like the fact that Horizons gives you three options instead of one. You have the long term, you have the medium term, and you have the short term. And in any one of these ETFs, if you just scroll down and open this document right here, you'll get this nice document which pretty much compares the three side by side. So the real main difference here is really the duration. So you see here SPAY is the shortest one, an average of less than 3 years. MPAY is 5 to 10, and LPAY, the longer one, is 10 plus years. So as you probably already know, right, the longer the duration, the more volatility you could have when interest rates go up and down. But I mean, all three of them invest in US Treasury bonds or T-bills, aka T-bills. So for all three, you'll see that the credit quality is AA plus, very, very high quality here. The risk rating is low on the SPAY, low on the MPAY, and low to medium on the LPAY, on the long-term one. Like I just mentioned why there's a little bit more, could be a little bit more volatility because there's more sensitivity to interest rates going up and down. So you have the breakdown here. So when it comes to SPAY, 90% of the ETF is in the 0 to 3 month US T-bill exposure, only 10% in the long-term exposure. MPAY is 60-40, right? 60 in the short term, 40 in the long term. And then you have LPAY, which is 80-20, 80 in the long term, 20 in the short term. Another interesting thing is that they use options to enhance the yield of all three ETFs. So all three ETFs will have yield, of course, because, you know, T-bills give yield, but they can write calls and puts options, call and put options to basically enhance the yield of all three ETFs. So if we could quickly look at them and break them down, and by the way, the management fees, 35 basis points for the SPAY, 40 basis points for the MPAY, and 45 basis points for the LPAY. Another interesting thing I want to mention is that they have .U versions for every single one of these. So without the .U, you could buy and sell them in Canadian dollars. The .U versions, you could buy and sell them in USD, in US currency, in case you're interested in that. So great options here from Horizon. So if we just quickly look at the holdings, it probably is not going to surprise you here. The long-term one is going to have, you know, just like the graph said, 80% in long-term. So these two ETFs are US listed ETFs. You have TLT, of course, one of the biggest popular ones from BlackRock. And then you have a Vanguard one. These are long-term US Treasury ETFs. And then you have 20% in the Horizons 0 to 3 month US T-bill ETF, just like we saw, right? 80-20. So, yeah, that ETF is this one here, ubill.u. So when you see this here, the Horizon 0 to 3 month US T-bill ETF, it's basically this ETF here, ubill.u, which is very, very short, 0 to 3 month. And you can see that right now, as of November 1st, that has a really nice yield of over 5%. And that's because of the interest rates going up, right? So the mid-term one, if you look at the holdings, it's going to have 60% in the U-bill, this ETF here, and then the rest in TLT in the long term. So the average, if you kind of take the average duration, it's 5 to 10, 60-40. You see that here. And when it comes to the SPAY, obviously the majority is going to be in U-bill. So let's check it out real quick. Holdings. Yeah, you see that here, only 10%, approximately 10% in TLT, and the rest, the majority in the 0 to 3 month one. So great options, great yield on all three of them. I mean, I have to say I'm pretty impressed. Very, very innovative and quality assets here. So it's really up to you. You have LPAY, you have MPAY, and then you have SPAY. And the management fees are a little bit different. And even the options, when it comes to the options coverage, you actually see the initial percent here, right? So you got 40% on LPAY, you got 30% on the MPAY, and a little bit less, 20% on the short one, the SPAY. So really cool options if ever you're in the market to add some fixed income to your portfolio, but you want enhanced yield. You have these three great options here from Horizon's ETF. So that's it for these three. They're US Treasury Premium Yield Suite. Again, check out this document here, which you could find in you go to any three of these ETFs, you scroll down, look at the documents, and you will find here it is. And they've all declared their first monthly distributions. By the way, you see that here, all three of them are going to have monthly payouts, monthly distributions, which is quite convenient. Now let's check out the new ETFs, so the rest of their new ETFs, part of their asset allocation suite. And to make it easier, and more clear, we'll actually check out all their asset allocation ETFs in order. Let's get to it. All right, everyone. So the last 4 brand new ETFs that Horizons came out with, the 4 out of the 9, are part of their new and improved asset allocation suite here. So this is their landing page. You see here, asset allocation.horizonsetfs.com. So now they have 7 ETFs to choose from. These are asset allocation ETFs, which is kind of like a one-stop shop, if you will, to get your perfect allocation mix between equity and fixed income, whatever, depends on your time horizon and your needs and your objectives. So we're going to go through all 7 of these ETFs in order to make it easier, and 4 out of the 7 are brand new ones. So let's start with we'll go from the most conservative first. So we'll start with HCON. This is not a new ETF. This is the Horizons conservative asset allocation ETF. Let me bring up the picture. There we go. So you see this is 60% in fixed income, 40% in equity, in stocks, right? So this is a conservative asset mix. And if you look at HCON, the holdings, first of all, the management fee is 18 basis points, MER is 13 basis points, so very low management fee. And if you look at the holdings, it's going to be a combination of several ETFs. So this is what these asset allocation ETFs are. If you look at the holdings, they're going to have several ETFs in them, which will give you exposure, right? That's 60% fixed income, 40% equity exposure. So you have HBB, which is the Horizons Canadian Select Universal Bond ETF. So this is obviously fixed income ETF. You have the US 7 to 10-year Treasury Bond, HTB, again, part of the fixed income here. Then you have the Horizons US Large Cap Index ETF, HEQL. So this is equity. This is big cap equity in the US. You also have some equity in developed markets outside of North America. This would be HXDM, the HXDM ETF. So things like Europe, Japan, Australia, things like that. You also have HXT, which is the TSX 60. So this is basically an overall Canada equity ETF. And then you have a little bit in emerging markets. So altogether, the mix is approximately 60% in fixed income, 40% in stocks, in equity for HCON. The next one, HBAL or H-balanced, is 60% equity, 40% fixed income. So HBAL is also not a new ETF. You have the management fee at 18 basis points, management expense ratio at 14 basis points. And if you look at the holdings, it's going to be similar to HCON, except it's going to have more equity than fixed income. So the ETFs, I believe, are actually very, very similar. There's the exact same ones, just the percentages are different. So it's going to be a little bit more geared towards equity, 60%, 40% fixed income. And the next one is a brand new ETF, the Horizons Growth Asset Allocation ETF. And this one is going to be 80% equity, 20% in fixed income. So this is a new one, everyone. This is the new one. Part of their asset allocation suite. Management fee 18 basis points. MER is not available because it's only going to be available after a year. And if we look at the holdings, you'll probably guess that it's going to have very similar ETFs, just that the percentages are going to be different to give you 20% fixed income and the majority in stocks or in equity. So you could see the breakdown here. And by the way, the first distribution has been announced at 4 cents. They're going to be monthly distributions, which is very, very convenient here. And you see the yield is approximately 2.42%. This is obviously, just like the graph says here, it's really for, not designed for yield, this one, even the other 3, right? They're more for growth potential, but I'm talking about HGRW here. So, most of it is going to be in equity, a little bit in fixed income here. And the next one is GRCC. So this is also a new ETF. This is actually a covered call asset allocation. So to make things simple, everyone, to make things easier to understand, it's basically HGRW, the one we just checked, or the one we just looked at, with a covered call strategy. So that's why you see that the yield potential meter is up here. You see that the yield is approximately 8.5% here as of November 1st. The first distribution was declared at 14 cents a month. And let's just look at the management fee real quick here. 49 basis points for the management fee. So what's in this ETF in the holdings? Well, you'll see some of their covered call ETFs in here, of course, because this is more of a covered call product. So you see USCC, which is a covered call version of HEQL, right? For US equity. You also have HXDM is in here again, developed markets outside of North America. Here's CNCC. This is going to be your Canadian equity position. But it is 20% in fixed income. So you'll see this ETF here, HBB, and the Horizon Midterm US Treasury Premium ETF. MPAY, which we just checked it out, is also in here. So you have these two ETFs here. These two will get your 20% exposure to fixed income, and the rest are going to be equity exposure. You have QQCC as well. QQCC, CNCC, USCC. These are your covered call index-based equity covered call ETFs from Horizons, and you also have a little bit in emerging markets. So total it up. You have a 80% in equity, 20% fixed income. You see the yield meter. It is a covered call version basically of HGRW to make things really, really simple. So this is very, very innovative to bring covered calls here to enhance the income to an asset allocation ETF, to a one-stop shop ETF. So if you really like the 80-20 mix, but you want enhanced yield, you have GRCC as an option now. They use options or covered calls to enhance the yield to a very respectable, approximately 8.5% here. So the next one is going to be HEQT. Very, very popular. This ETF is not new. It's not one of the new ones, but it's actually very, very similar or same style, you could say, to XEQT or VEQT, the Vanguard and BlackRock, core equity ETFs, where they basically combine some of the best equity ETFs, index ETFs, into one. Right, so that's why you see it's 100% equity here. There's no fixed income in here. If you look at the holdings, you're going to get only the equity or the stock ETFs. And you'll probably recognize them because it's a lot of the same ETFs. These are all within, these are all Horizons ETFs. So you have the US large cap, developed markets outside of North America, TSX 60, which covers Canada. You have the NASDAQ 100, and you have emerging markets. So this is basically an option where you want all stocks, all equity, all over the world in one ETF. Very, very popular. Like I mentioned, it's very similar to XEQT, even has the last three letters, right? And VEQT, BMO also has one, ZEQT, so they kind of, they're all very similar. HEQT is Horizons one. And you could go ahead and do the comparison, the performance and the management fees, but I will say that HEQT is very competitive. Management fee is 18 basis points, MER of 0.15 here, 15 basis points. So now we have HEQL. This is very innovative. This is another one of their brand new ETFs. And just like the name says, very simple to understand. It's basically HEQT with 25% leverage. So you get a little bit more growth potential. That's why you see the growth meter at the max here. Right? 100% equity, 25% leverage. I love these little graphs, by the way. So it's very simple, everyone. You look at the holdings and it's just 125% of HEQT, which we just saw. So very, very innovative. So if you don't mind more volatility, you want potentially enhanced growth over time, this could be a great option. I found this was very, very innovative. Again, this is gonna have a 0.45% management fee. So if you don't mind a little bit more volatility for potentially more growth potential over time, HEQL could be a very interesting option for you. So the next one, the last one, this is also brand new, is EQCL. So this is the Horizons enhanced all equity asset allocation covered call ETF. So if you look, you will see that just like the last two we saw, it is 100% equity. There is 25% leverage as well, but this one uses covered calls to enhance the yield. You'll see that big yield difference. So this is very, very innovative. You could think of this one basically as HEQL with covered calls. That's probably the easiest way to think about it. Management fee is 75 basis points. And if you look at the holdings, you will see them here. You'll have the breakdown over here. So you have USCC, CNCC, QQCC. These are covered call ETFs that covers the NASDAQ, Canadian large cap, and the US large cap. But you also have HXDM again in here, which is developed outside of North America. Developed markets outside of North America, and a little bit of emerging markets. If you add up all the totals, you'll get to 125 because it does use 25% leverage. So if you're an income-oriented investor who wants 100% equity, covered calls, and also doesn't mind a little bit of leverage for enhanced yield and enhanced growth, potential growth over time, EQCL could be a great option. So I hope this video was informative for you. I went through all 7 in order. Again, I strongly suggest you go on Horizon's website to analyze them yourself, but you know, the order, it's pretty simple to understand them, especially if you go on the website and look at these graphs. I find that they're really, really well explained. So again, you have HEQL, your conservative one, the conservative asset allocation ETF, which is, you know, 80%. Let's just go back here. 60% fixed income, 40% equity. You have HEQL, which is 60% equity here and 40% fixed income. Then this one, which is a brand new one, you're going to have 80% equity, 20% in fixed income. You have GRCC, which is basically a covered call version of HGRW, you could say. So it's going to have enhanced yield. You could see that. HEQT is not new. It's the 100% equity. Then you have HEQL, which is a leveraged version. It's HEQT with 25% leverage. And then you have EQCL, which is kind of like HEQT with 25% leverage and covered calls. Or you could say it's a covered call version of HEQL. So I'm not trying to confuse you or anything, but I've gone in order. I strongly suggest you go on the website, check them out for yourself, check out the holdings. So you have 7 choices when it comes to these asset allocation ETFs. I find these are very, very innovative, impressive, very, very high quality stuff. Check them out for yourself. I strongly suggest it. Thanks for watching and see you next time.